Today is June 26th of 2026, and once again for this Gold Matters discussion, I am joined by my colleague and friend and partner here at Von Greyerz, Jonny Haycock. Now, Jonny, I'm looking forward to sharing some important thoughts with you today on the gold market.
Well, look, thanks, Matt. It's an important discussion. This clearly, precious metals are going through a correction, and hopefully, for our audience and for our clients, we can shed a little bit of light on what's going on, why it's happening, and where we go from here.
Precisely. And Jonny, as you know, we at Von Greyerz take a much longer term perspective on precious metals. And this is because we understand the metals as a longer term wealth preservation allocation against systemic financial risk in general, but of course, against the openly obvious and now historical currency risks, which are playing out in real time. And despite gold having nearly doubled in price from where it stood just 2 years ago at this time, we must nevertheless be respectful that while we do think much longer term and constructively on gold, the markets right now think very differently. And starting with the numbers, and as this graph reminds, the current gold price has only lost 5% from its December 2025 close, a year which, by the way, saw a 65% price rise. But gold has fallen by 29% from this year's January all-time high. So clearly we need to address the explanations for this near-term retracement, as well as some of the longer-term tailwinds for gold. Now, these price movements are compelling. They deserve clear perspective. And again, although gold has risen by 128% in just the last 5 years, and frankly by nearly 1,600% since 2000, this current correction is a useful reminder that even the strongest structural moves can be tested, and that even otherwise bullish runs don't move in straight lines or without critical shakeouts. So, Jonny, I'd like to begin with your perspective on the factors, or better yet, current explanations for the correction we are now seeing in gold at this mid-year point. In other words, what are some of the critical themes behind this downward pressure on the metal, Jonny?
Yeah. Absolutely. And the context is important. Before I get on to what I think are the three main factors that are driving this correction at the moment, which are a counter-trend rally in the dollar, higher real rates, and some forced liquidation that we've seen. I think those are the three sort of big picture reasons why we're seeing the sell-off at the moment. I think a little bit more context is also important, Matt. I mean, you allude to the fact that it doesn't matter whether you're investing in gold, you're investing in stocks, or you're investing in bonds. All bull markets, all secular bull markets have corrections. That is just the nature of the beast. And, bull markets test investors all the time. And look, it has been a long-standing Von Greyerz view that we have moved decisively into an inflationary world. Egon von Greyerz always reminds us, doesn't he, Matt? I mean, how often does he tell us that bond markets tend to move in 40-year cycles? Interest rate cycles tend to move in 35 to 40-year cycles. And the last great bull market in bonds lasted about 40 years and ended in 2021. And we're 5 years in to this bear market in bonds. We're 5 years into this new interest rate cycle. And what we are seeing are interest rates normalize. And if we go back to the 1970s, which I think is the most relevant decade and playbook for what we're looking at here, Matt, i.e. a high inflationary world and low growth, then sadly, it's a stagflationary period of the 70s, which probably gives us the best historical playbook to try to get some guidance from. And it's worth reminding that in that period, gold went up 28 times, but there were 5 episodes where gold had more than a 20% drawdown. And this is a bit of sort of historical fact. But in between 1974 and 1976, gold actually halved. It went from $200 to $100. And then we all know what happened after that. Between sort of December 1976 and 1980, gold then rallied eightfold and to peak at $850 an ounce. Yeah. I mean, you can imagine how sick investors might have felt as they're watching the gold halve from 200 to 100, only to sell at the bottom thinking it's all over,
Right.
and then just to see it sail up 8x. So look, our view, and we could be wrong, but this is our view, is that the secular bull market in gold hasn't changed one iota. There's simply too much debt in the world. Keeping it simple, there's simply too much debt in the world. And we'll come on to that a little bit later. And there will be forced printing of money, and the great debasement trade that is being challenged today is still intact. And I know you're going to talk about this. So we have to just keep this as just a normal correction in a secular bull market.
Totally agree.
So just turning then to what is the market though thinking at the moment? What is Mr. Market worried about at the moment when it comes to precious metals? And I would say, as I say, there are three things. When the Iran war started, you had a very typical and standard run to the dollar. So as you and I know, as Egon has written on countless occasions, the dollar has collapsed against gold by 98% since 1971. And given where debt is today, that trend is still very much intact. What we see, though, in times of crisis, and we saw this with 9/11, we saw this with the Russia-Ukraine invasion, we saw it with COVID, and many other examples, is the knee-jerk reaction to a crisis, the crisis being in the Middle East at the moment, hopefully coming to an end, is a rush to the dollar as a safe haven. And that can lead to a sale of gold. So, for instance, 2008, 2009, forced liquidations from investors. It was autumn of 2008, when the world was falling apart. Gold fell 29% over I think it was an 81-day period. Well, interestingly enough, gold has fallen about 25%. And guess what? In roughly an 80-day period. History may not repeat, but it certainly rhymes. And that is quite normal before then rebounding and carrying on up. I see no reason why that isn't going to happen today. So Iran caused selling of gold. We know that there are well-known central banks that were forced to sell some gold, whether it's Turkey or Saudi Arabia, whether for importing oil or whether it was for shoring up their currencies or for food shortages. They were forced to sell some of their gold. Bear in mind, who was on the other side of the trade? China, right? That doesn't get quite so reported, but they were there hoovering up all the gold. Yep. So we had forced liquidation. And don't forget, Matt, this was just after we'd seen this parabolic move in gold and silver, of course, at the start of the year. You know, one has to remind oneself that gold rallied 30% in January alone before that January 29 peak. Do you remember we saw the line, those lines of people queuing up in, Kuala Lumpur and Australia and even in London, of people queuing up to buy their gold. Obviously, that was a short-term top, right? In hindsight, we can say that is what happened. And the margin hikes came in on COMEX, and suddenly you had that Silver Friday crash, one of the largest one-day moves in history. And if you're a levered retail investor, you have no choice. There's a margin call, you're forced to sell. So point one, there's been forced liquidation. I think we now move on to, and the counter trend rally in the dollar. But I think the most important thing just to talk about is real rates. And obviously last week we had Walsh make his debut at the FOMC, and it was a hawkish Fed. And the market is now worried about interest rates, right? Real rates that have been rising fast. And this, I think, is really, really important, because trying to predict what the Fed will do is a mug's game, right? Again, as Egon always tells us, the central banks don't set rates. The bond market sets rates. But I do think that whilst we disagree with what the market is currently pricing at the moment, it's important for us to try to explain what the market is thinking. And the market is thinking, look, you've got higher real rates, therefore owning a non-yielding asset like gold is less attractive. Okay, it's kind of as keeping it as simple as that. What people, I think, should realize, though, is that life is rarely that simple. And since 1997, there have been 40 rate cycles. And this is some analysis the World Gold Council did. And what they showed is in the 40 rate cycles since 1997, gold actually outperformed after 50% of rate hikes. So in 40 cycles, World Gold Council showed that actually even after the first rate hike, gold outperforms 50% of the time. That's counterintuitive, but that is what the facts then show. So I think it is what is more important, Matt, is not the policy rate, it is the context within which we find ourselves. And that is what is critical for gold's performance. And I'll just pause by saying that, because I know you're going to talk a little bit more about this, but there are two good examples to show actually that even in a rising real rate environment, 2003 to 2006, but also between 2018 and 2024, these were periods where real rates, I think, almost doubled. And in the first period, gold went up 85%. And in the second period, it doubled.
Yeah.
So I think that, piecing it all together, the market is worried about rising real rates. And that is clobbered gold and clobbered silver.
Yeah.
But history would show that can very easily be a wrong signal. And I think now perhaps would be a good time for you to talk about actually why the market has probably got this wrong. Fundamentals haven't changed one bit. Yeah. And that this is just the most incredible opportunity to be buying and following the likes of China.
No, Jonny, it's really good to put in context these key drivers of what the market thinks, because what the market thinks does matter. And what I want to talk about are three other points, because I see negative, not positive real rates right now. And I think the real story is not the US dollar, it's the US Treasury. And finally, I think that the setup for gold in 2026 is nearly identical to the 2022-23 period before gold went to the moon. Now, as to real rates, to your point, the current headline and narrative of positive real yields, how government bonds yield well above official CPI inflation, this is a very powerful optic. It's a headwind for gold. After all, if on the surface bonds appear to be offering real yields and pet rocks offer no yields. So naturally, the markets follow this optic. But this is a deliberately misleading optic for a couple of key reasons. First, and as you know, and as Russell Napier confirms, governments with their backs against a debt wall have no choice but to run negative rather than positive real rates to inflate away their debt by debasing the currency and then frankly lying about the actual inflation. And I've written about this CPI lie for years. This is the oldest trick in the history books of desperate nations losing their hegemony and their currency due to, frankly, the gross mismanagement of their debt. And the US, with nearly 40 trillion in government debt, is doing precisely that. Again, as I and many others like John Williams have argued for years, the BLS CPI scale is completely bogus, but it is what the market follows. And without diving into the technicals, to me, honest as opposed to official inflation is much closer to the 8 to 10% range than it is to the official 4% range right now to DC. To me, honest CPI percentages are far more correlated to annual debt growth rates, which are around 8%. So this means, Jonny, that a 10-year US Treasury today is in fact offering a negative return or yield of at least negative 4% rather than a positive yield. Yep. In other words, buyers of US bonds are losing money from the moment they make their bid. And most investors simply aren't told this. The retail market, which I've said is the classic plankton, is getting panicked out of the gold trade by misleading headlines on real yields at the same time that central bank whales are hoovering up, as you said, all the gold at levels never seen before and at a massive discount. Central banks are proactive buyers. They're structural buyers. These central banks know the longer term play, which explains why, despite a deliberately repressed gold price today, central banks are stacking it in a fire sale with the help of the New York and London exchanges and now hold more gold than US Treasuries. And this, Jonny, really brings me to my second and longer point or larger point, which is the tanking trust in US IOUs, which is now hiding in plain sight. And this year, the number of emerging market central banks who said they no longer trust the US dollar and US Treasury-based system has doubled. more than half of the emerging market banks see a declining rather than rising role for the US Treasury as a reserve asset. But meanwhile, in the West, everyone, and I mean everyone, is talking or reading about the dollar or the rising DXY and this higher yielding environment. But to me, Jonny, as I've said for years, the real story is not the dollar, it's the US Treasury, which is losing its status and trust as a global reserve and collateral asset. Again, this makes sense because the world in reality trades, circulates, lends, and moves on collateral, not just dollars. And for years, excuse me, the wind just blew my door shut. For years, the US Treasury was that sacred collateral in everything from bloated derivative markets and intrabank lending to cross-border trades. But since we weaponized that dollar in 2022, gold is not only replacing US Treasuries as a central bank reserve asset, it is serving as a core collateral asset in the global financial system. Now, this is an empirical rotation out of US Treasuries into physical gold as the new collateral for the global system. It is not a gold bug apology, and it's really a hidden and deliberately ignored signpost of a massive and systemic shift in the global financial system. Again, this shift is driven by the hardest metric to track, Jonny. It's trust. And the world has objectively lost trust in Uncle Sam's debt-sick IOUs. And again, this isn't just a sensational statement. The evidence of this distrust is literally everywhere. Japan, which is the US's largest foreign holder of US Treasuries, just sold more US Treasuries in the first quarter of this year than they did in the last 4 years combined. And China, which once held over 1.3 trillion in US Treasuries, now holds half of that number. The central bank preference for gold over US Treasuries is a screaming signpost. And so is the BIS granting gold a tier 1 status alongside this laughable US 10-year. But perhaps most obviously, ever since the US weaponized the dollar and the treasury in 2022, central bank stacking of gold has increased by 5x. And China just completed its 19th straight month of net buying. So, Jonny, in plain speak, gold is far more trusted as a current and future store of value than US Treasuries. And by the way, and I'm not predicting this or anything, but the very fact that DC and Judy Shelton, who's a former Fed nominee, are even considering out loud or discussing a long-dated gold-backed US Treasury is really an open confession that even the US recognizes that gold makes their own IOUs more trusted than just the full faith and credit of Uncle Sam. The banks are quietly showing us the longer-term direction of gold's role and price. And what this means for gold should be obvious, yet it is largely misunderstood by the vast majority of, I hate to say it, traditional investors. As less loved and less trusted US Treasuries sell off, their prices drop, but their yields rise. And those yields represent the cost of debt. And the US interest expense on this debt is already greater than $1 trillion per year. It's very simple. Tax receipts and GDP cannot match this debt. And the only way to fill this gap is for the US to use open or backdoor QE, in other words, dollar debasement, to allegedly solve this debt trap. In other words, the currency is being sacrificed to support the dying US Treasury. This is a massive tailwind longer term for an anti-fiat or anti-dollar asset like gold. And again, how do I know this? It's not sensational gold bug apologizing. It really brings me to my final point, and it's short. But we've seen this movie and this high yield, low gold setup before, and it was just a couple years ago. For me, I mean, really, the brevity of investor memory can be amazing. Between 22 and 23, under Powell's higher for longer rising rate regime, we saw the same rising yield and rising DXY or dollar setup as we're seeing today. We saw gold yawn or go down, as well as the markets. But what is even more scary, Jonny, about today is that yields and rates are rising now, even without a Fed or a Powell higher for longer policy. Yields are rising because trust in this over-indebted, weaponized US Treasury is tanking globally. So the Fed is literally losing control of rising yields, which it cannot afford. But most importantly, and I'll close on this, these rising yields today will create the same fiscal dominance disaster we saw at the close of 23. That is an inevitable and unavoidable mathematical pivot towards more dollar debasement, again, direct or indirect, backdoor or open QE, to pay for the rising yields and costs of Uncle Sam's bar tab. Now, this leads to and accelerates the debasement trade, which sent gold to the moon in just the years thereafter in 24 and 25.
And
So
I think
Johnny,
that's the important. Sorry to interrupt, but
yep,
just I'm sorry. I think that is absolutely key. Is that
yep.
the market today is questioning the debasement trade.
Well, it's finally got a name, but
And
it's been
what you're
happening
saying,
for years.
yeah,
Yeah.
and what you're saying is that the debasement trade is completely unchanged. That
Yeah, and what we're
the structural drivers behind it
completely
are still
and
intact.
what we are seeing this year is an almost identical pullback prior to a launch forward in gold. The debasement trade, Johnny, isn't theoretical, it's mathematical, it's historical. We
Yeah.
have no other way to pay our insane debts other than by debasing the currency.
Yeah.
So, like the central banks, now is not the time to be buying to be debating about gold. It is the time to be buying gold. And I think that's the key point. It's the treasury market, boring, eye rolling, but so critical. Trust, hard to measure. Real rates, negative rates, positive, very easy to manipulate. But the bottom line is the dollar is being debased to monetize the debt. Anti-fiat assets like gold have no place to go but up in a secular direction, despite these pullbacks right now, which are very familiar structurally, technically, and fundamentally. And those are the key points, Johnny. And I don't know if there's anything else you want to close on, but I think we've hit some
Yeah.
core themes here.
No, I know. I mean, there's a danger that we can be a bit too wonky on rates, but hopefully, the reasons about why the market is doing what it's doing. Hopefully, that we have
Yeah.
articulated that in terms of higher real rates, forced
Yeah.
liquidation, and a counter trend
Yeah.
rally of the dollar, right? But that is what happens in bull markets. You get these counter trend moves, and hopefully, we've given some good data to show actually that when rates rise, gold can do incredibly well a lot of the time. And I think it's also interesting that here we are, Matt, we talk about that we're now into a much longer term 35, 40-year interest rate cycle. Let's not forget the stock market, where the Warren Buffett indicator is showing that at 230% of market cap to GDP, it's never been higher.
Crazy.
And on just traditional cyclically adjusted PEs, I think it's 41 times for the S&P, only been higher once before in first quarter 2000, and that didn't really end very well. And quite interesting that we've had this sort of AI SpaceX listing
Mania.
euphoria,
Yeah.
and now it's all just starting to roll over a little bit.
Yeah.
So look, it's going to be very interesting to see if as and when the stock market, the bubble pops, then maybe people might, turn back to gold for all the fundamental reasons that they've already been liking it for the last few years.
Yeah, that's true.
Maybe I just close, by trying to just keep it really, really simple, and that is, when countries and government get as indebted as they are today. History shows over centuries, right, that there are only two options. Countries either default, typically the case in emerging markets, or there's a dishonest default. And this is what you're alluding to, is just printing money to inflate away the debt. And that is what has always happened, and that is what is most likely to happen as we go forward over the next coming years. And I think people will then look back on this natural correction as the most wonderful opportunity to be protecting wealth in the face of fiat currencies that are just losing value every single day, and that we've seen that trend, and that trend is still intact. Matt, I think we'll leave it there. I think we're up to almost 20 minutes or something like that.
Sure.
But great discussion, important discussion at this time, given what's going on in our market. And let's do this again soon. Thank you.
We shall, Johnny. Very good and very good points. Couldn't finish it better myself. And always enjoy these conversations. And we will definitely be having more publicly. We have so many privately, but this will be great to share again with others. So thanks again, buddy.
Okay, sure. Bye-bye.